This is not a forecast, but just simple math, simple data. If gold repeated the performance it gave from 1971 to 1980, in terms of the percentage decline of the dollar, gold would be $100,000 an ounce. If you replace 71 to 80, yeah, I've got gold going to $10,000, which at this point is, I'm not giving a lot of thought to it and followed it for a very long time. That's kind of a commonplace projection. You know, you go on the web and podcasts and everything, yeah, gold's going to go to $10,000, et cetera. So, you know, what's the value added in that projection? I would say that it's going to hit $10,000 a lot faster than people think. And there are some interesting reasons for that. I mean, we can go into the fundamentals and explain why gold's going up. I'm happy to talk about that. But in terms of that price target and getting there, probably in 2026 and maybe not even that far into the year. I always like to keep the math at the 5th grade level, at least when I was in 5th grade. You know, but there's a behavioral psychological phenomenon called anchoring. And the idea is you get an idea in your head, it could be a number or a theme or whatever.
Gold and silver investors, pay close attention because what's happening right now in the global financial system is bigger and faster than most people realize. Central banks are buying gold at the fastest pace in more than half a century. Silver supply is tightening, and the world is slowly drifting away from the US dollar. And now, Jim Rickards is sounding one of the strongest warnings of his career. If gold repeats the same pattern it followed from 1971 to 1980, we could see prices skyrocket toward $100,000 per ounce. That may sound extreme, until you hear the math and understand the real situation unfolding beneath the surface. Today, we're breaking down Rickards' message, how it connects to current gold and silver market events, and why he believes the next major move could happen faster than anyone expects.
And you anchor on it, and then you begin to filter all the data you're getting through that anchor, and it can change, but that's a very, very common phenomenon. So people will look at gold, and they'll have a number, let's just say $1,000 an ounce. So it goes from, you know, $2,000 an ounce to $3,000 an ounce. Now it's made its way to $4,000 an ounce. And that took a while, it took a couple of years. I mean, percentage-wise, these are good gains, but that took a couple of years. So they go, oh, wow, $10,000. It seems like the dark side of the moon. It's going to take forever to get there. But the math is that so if you have 50 ounces and it goes up $1,000 an ounce, you made $50,000. Okay, it goes up another $1,000 an ounce, you made another $50,000. So you're anchored on the $1,000 steps and the $50,000 you made, which is all true, and that doesn't change. But when you go from 2,000 to 3,000, that's a 50% gain. When you go from 3 to 4, that's only a 33% gain. Well, when you go from 9 to 10, that's only an 11% gain. That's like a good month the way gold's been trading lately. So the point is, people kind of lose sight of that. So yeah, 3 to 4 made it, 4 to 5 getting there. But you're going to go 7, 8, 9, 10 really quickly because those are smaller percentage gains.
Yeah.
And that's something that people, you know, they extrapolate 2 to 3, how long is it going to take to get there? The answer is probably not very long. That's absolutely right, but we're not at the frenzy stage yet, which is important because retail's not all in. I mean, I was just down in Australia not long ago with friends from ABC Bullion. They have an office in the central CBD, central business district, and a friend of mine sent me a picture the other day. They were queued up around the block, waiting to get in to buy physical gold, but that's recent.
Very recent.
Yeah, well, that's right.
It doesn't happen around here.
It does not happen in the United States. The U.S. will probably be the last to get there. You know, it's happening in China because they don't have too much else to invest in, and it's sort of caught on in Australia. Bearing in mind, you got to take in their currency is going down against the dollar, so gold's going up even more in terms of their currency. So these are kind of at least mild psychological effects that go beyond the fundamentals. And again, we can talk about the fundamentals. But yeah, it's if you take 1971 to 1980, so gold went up 2,300%. But another way of thinking about it is that gold didn't do anything. It's gold, atomic number 79, it's an element. As you put it in a drawer, come back a year later, open up the same amount of gold. So what's really happening when gold does something like that? Well, what's happening is the dollar is collapsing. So if you measure by weight of gold, and that's it's not arbitrary, but it's just a metric, measured by weight of gold, the dollar declined 95%, approximately 95%. So there's your dollar crash. Everyone's like, when's the dollar going to crash? Well, it did, measured by weight of gold. So that's starting to happen again. And that gets into a much bigger narrative. You know, when you say what's going on with gold, there's there's a narrative. Wall Street loves narratives. Some of them are completely just wrong. They're kind of made up because Wall Street always needs a story to sell you stuff. Some of them are they're self-fulfilling. Like they start out not true, but they become true because people buy into them. And then some of them are right. So you can't just say narrative. You gotta, Robert Shiller wrote a good book on this, but you gotta figure that out. But the narrative. Let's start with the narrative, which I think is almost completely wrong. And then we can talk about what's actually.
The narrative on why it's going up or why it shouldn't have gone up?
The narrative on why gold is going up.
Okay.
And then we can flip to what.
Because there are plenty of narratives on why it shouldn't have, which were dead wrong too. But.
Right. But it's important because it's what you hear. Like you go again, podcast web.
So this is like
CNBC.
macro tourist type narrative on why gold's going up.
Correct. But then there are real reasons why gold's going up.
So let's
I
do
think
both.
For an investor, it's important to get the real reason. So the narrative is. The U.S. is $37 trillion in debt. Actually, it's just got to 38 the other day. So I have
The debasement trade.
The debasement trade is exactly what it's called.
I just summarized Luke Roman's entire being.
Oh.
Anyway.
Well, he might be in part of the narrative. So yeah, $38 trillion of debt. The highest. It's too much. We can never pay it off. Well, first of all, quick aside, we haven't paid off the national debt since Andrew Jackson, 1836. Was the last time the United States was debt-free. So you're never going to pay it off, and you don't have to. They have 38 trillion, banging the table, boom, boom, boom. China's dumping treasuries. Everyone's dumping treasuries. Bond vigilantes have saddled up. Interest rates are going up. Interest rate on the debt alone is greater than the defense budget. U.S. is going bankrupt, et cetera, et cetera. Buy gold. Everything I just said is false. I mean, it is the narrative, but let's just kind of put that in context. Number one, the debt is $38 trillion. That's looking at the liability side of the balance sheet. You got to look at the asset side. 150, 200 trillion, don't know. Are we going to sell Yosemite? No. We're going to sell the Grand Canyon? No. But there's an awful lot of mining rights, mineral rights, oil, natural gas, Gulf of America, intellectual property, none of which the U.S. has monetized very effectively, a lot of which we actually squashed. So I'll give Scott Bessent credit for that. He was trying to monetize the asset side of the balance sheet. So that's one thing. Number two, you don't have to pay off the national debt. In fact, we're not going to. You don't even have to pay it down. So the key metric, and the only one that really matters, is the debt to GDP ratio. What is the government debt to GDP? And one way to think about that is, let's say you owe $50,000 on a MasterCard. Is that a lot or not? Well, you can't answer that question without knowing how much money you make. If you make $20,000 a year and your interest rate is 28%, you're probably going broke. If you make $500,000 a year, you write a check and it's done. So you have to put the debt in the context of the income. That's why the debt to GDP ratio is is powerful. Now, right now it's about 123%. 37 trillion of debt, GDP's 30-ish, 29, 30. So it's 123%, which is the highest in history. And that's not a good thing. I'm not sloughing it off for saying we should ignore it. It's not a good thing at all. Highest in U.S. history. But at the end of World War II, it was 114%, which was the highest at the time. Of course, we won the war with our allies, so that was good.
Rickards opens by making one thing clear. He isn't predicting. He's simply running the same math that anyone can run. Between 1971 and 1980, the moment the U.S. left the gold standard, gold rose over 2,300%, while the dollar effectively lost 95% of its value when measured against gold. If that pattern repeated today, he says, gold wouldn't just rise. The dollar would be the asset collapsing, pushing gold toward astronomical levels. He explains why most investors completely underestimate this possibility. It's called anchoring, fixating on specific price ranges like $2,000 or $3,000 and assuming the next move will take just as long. But as Rickards points out, percentage gains shrink as prices rise. A move from $2,000 to $3,000 is a huge 50% jump. But a move from $9,000 to $10,000? That's only an 11% change, small enough to happen in a matter of days or weeks once momentum starts. And here's where today's market comes in. Gold is hitting new all-time highs, while central banks, especially China, Russia, India, and Turkey, are aggressively adding to their reserves. This is the strongest central bank gold demand recorded since the late 1960s. At the same time, silver is sitting far below its inflation-adjusted highs, even as industrial demand rapidly increases due to solar, EVs, and electronics. The stage is set for silver to play catch-up if gold accelerates. Rickards' message gets even more important when he challenges the mainstream economic narrative. People panic about America's $38 trillion national debt, but he argues the only number that truly matters is the debt-to-GDP ratio, not the raw total. The U.S. has been in worse shape before. After World War II, debt-to-GDP was 114%, yet by 1980 it had fallen to 32%, even though the total debt had tripled. The key difference was strong nominal growth. He also dismantles the myth that foreign countries are dumping U.S. treasuries. According to official Treasury data, the TIC report, major holders like China and Japan have not dumped their bonds. If anything, when they occasionally sell treasuries, it's because they need dollars, a sign of dollar strength, not weakness. Now here's the core insight. Rickards believes the U.S. is not yet in the retail frenzy stage. In places like Australia and China, people are lining up at bullion dealers. But in America, retail buying is still muted. Historically, a clear sign that the big move is still ahead, not behind us. This brings us to the deeper analysis. Gold isn't rising because speculators are getting excited. It's rising because global confidence in the dollar is slowly eroding. Central banks are preparing for a monetary reset. Financial markets are strained under historic debt levels, and silver remains dramatically undervalued relative to gold, setting up a potential explosive move when the dollar weakens further. Rickards' message is simple. Gold and silver are not speculative bets. They are insurance for a world where currencies lose credibility and governments rely on inflation instead of discipline.
By 1980, at the end of the Carter administration, when Reagan came in, that number was 32%. So how did we get from 114% to 32% in terms of the ratio, which 32 is very comfortable, by the way. It's like practically having no debt. One thing we did it took 35 years, from 1945 to 1980. One thing that impresses me about that accomplishment, it was completely bipartisan. You had Democrats like Harry Truman, JFK, LBJ, and Jimmy Carter. You had Republicans like Dwight Eisenhower, Richard Nixon, Gerald Ford. But it was not, they politicized everything else. They could argue about lots of stuff. They did not argue about that. They said, we gotta get this down. Now, here's the bottom line. The national debt in 1980 was 3 times what it was in 1945. The deficit, annual deficit in 1980 was 3 times what it was in 1945. So the deficit tripled, the debt tripled. Well, how the heck did we get the ratio from 114 to 30? The answer is growth.
Yep.
Growth was 10 times, and that's the key. So this is what Scott Besson is working on. He calls it the 3 arrows, which is fine, not the Japanese 3 arrows. But he says if you keep deficits at 3% of GDP or less, and get real growth at 3% of GDP or more, notice I said real because when you do debt analysis, you have to use nominal debt. So with 2% inflation, which is low, but 2% inflation, your nominal growth is 5. And then he wants 3 million additional barrels per day of oil production, which will help keep gasoline prices down. But just take the first 2. If the debt's growing at 3% a year, and the economy's growing at 5% nominal, 3 plus 2, then the ratio is going down. And that's all the market has to see. It's like, and if you did that for 1 year, your debt to GDP would go from 123 to 121. Everyone's like, hey, 121 is still pretty high. Yes, but it's moving in the right direction. We're sort of replaying what we did after 1945. Now, so the math is simple. The math is simple. The plan is straightforward. Whether you can pull it off or not is a different question. That's a policy question, and that's what I'm watching. Forget, the debt's not going away, the deficit's not going away.
Yeah.
They're both going up. But if we can get growth and nominal growth, and you can't rule out inflation, by the way. Inflation is a great way to get nominal growth. So I'm not dismissing inflation, but I'm saying nominal. When you do debt analysis, it's nominal. If I owe you $1, I owe you $1. Interesting whether it's worth $1.05 or 95 cents in real terms, but it's a contract. I owe you $1.
Yeah.
And so that's how you think about the debt to GDP ratio.
I like to say interesting but not useful. I borrowed that from my friend, Mike Green.
That's not going away. It's getting bigger. Deficits are not going away. They're getting bigger. But if growth is sufficient and it's nominal growth, not real, that ratio goes down and we're in good shape. Now, take the next part of the narrative. Everyone's dumping treasuries. Well, Again, I always find it's good to stick to facts. The Treasury Department has a monthly report called the Tick Report,
Yep.
and it's basically, it's a simple spreadsheet, and it's like all the countries in the world and what treasuries do they own and how many U.S. treasuries do they own by maturity. You can look at it. It's not going down. And the Chinese, about a year ago, they sold a little bit. I'll come back to that. But they're not. That's very constant. They're not loading up, but they're not dumping treasuries. That is just not true. And you can look at the Treasury data and you can see it. Now, if they do sell treasuries at all, they actually wish they had more. They're not dumping them. That's nonsense. They're desperate for dollars. And this is where people get thrown off because, like, oh, the dollar is the leading reserve currency in the world. Well, not really. It's because reserves are not held in cash. They're not pallets of $100 bills. They're assets. And securities are not money. So U.S. Treasury securities, yes, that is the #1 reserve asset in the world. It's denominated in dollars, so let's think about dollars. But they're not actually dollars. If you want dollars, you have to sell the Treasury and get the dollars. If China does that, why? To prop up their currency and prop up their banks. That they wish they had more dollars. So, so the dumping Treasury narrative is not true. The data shows that they've been pretty constant. They're not loading up, but they're not dumping them. They're just rolling them over. But if you do see them selling, don't take that as a signal that they're dumping it. Actually, that's a very distressing signal because it means there's a dollar shortage, which kind of precursor to maybe a global monetary crisis. I'm not forecasting that, but that's one of the things I'm watching.
You know what's interesting about that too is that, I mean, if that was true,
right,
and bond yields went up on the supply side of the trade, I would definitely see that as a bearish signal for gold.
Right.
Bond yields are trending down. They're not trending up.
That's right.
Right? Like, so, and the other question, getting back to the quads, is there's only one, you're the person who taught me this. You mean, you're like, look, it's not just a deflation bet or an inflation bet, it's both.
Right.
Like, you taught me this, like, how many years ago did you write your gold book? It's like the greatest book. It's just like an actual gold cover. It's,
the cover alone is worth the price.
It's awesome.
Well, it turns out you cannot reproduce the color of gold without putting a little bit of gold in
Yeah.
it. No, so
it's worth quite a bit.
Totally, yeah. And it's never come out in paperback except overseas, so you get a nice shiny cover.
But what I was gonna, like, when I put that in my framework, I'm like, okay, that makes sense because I have 4 quads, and gold really only doesn't like one of the 4, which is quad 2.
Right.
And quad 2 is typically where interest rates are breaking out to the upside, and in particular if they're breaking out at an expedited pace for a good, healthy economic reason where it encourages people to buy everything else.
Yeah.
So that's, it's like, again, it's bass backwards how people think about it.
And that's what we had from the mid 80s to around 2000, and that was a long bear market for gold. It went down and then it kind of just was flat. It was boring, actually. But we had very good economic growth, and this is not a forecast, but just simple math, simple data. If gold repeated the performance it gave from 1971 to 1980, in terms of the percentage decline of the dollar, gold would be $100,000 an ounce. If you replace 71 to 80.
Here's the bottom line. If the dollar continues following the same weakening pattern we saw in the 1970s, gold and silver are positioned for a historic revaluation. Whether gold reaches $10,000 or something far higher, the forces pushing it are already in motion. And the biggest gains always happen before retail investors wake up. If this analysis helped you understand what's really happening in the gold and silver markets, hit the like button, subscribe, and turn on notifications so you never miss these deep dive updates. Your support helps this channel keep bringing you real information, not the filtered version you get from mainstream media. Before you go, answer this in the comments. Are you stacking gold, silver, or both? And why? I'll be featuring the best responses in an upcoming video. Stay informed, stay prepared, and keep stacking smart.